good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're wrapping up our coverage of the banking sector, and we're taking a look today at First, or the First Citizens Group, as well as an overall wrap of the banking sector's performance with all of their fiscal 2020 results having been posted. So it's been quite a tumultuous year, a challenging year for the banking sector, as well as the wider market. So let's take a look at how First would have performed. And turning quickly to First, we can see that the group would have reported an earnings per share figure of $2.40, which is roughly a 20% decline from that $2.98 recorded in the prior comparable period. Now, the good news is that on the income side, or income generating side, things were fairly stable. Net interest income was just down around 0.4%, so you can say flat. Total net income was down just around 1.8% from 2.275 billion to 2.234. The big driver, as has been the case with many of the other banking groups, would have been an increase in credit impairment losses, which would have increased from 22.3 million for First in fiscal 2019 to 216.7 in fiscal 2020, an 873% increase. So overall profits after taxes would have declined at 751 million to 606, or that 19.3%, which we would have spoken about. When we take a look in terms of profits before tax by segment, we would note that there would have been some major changes to the retail banking and corporate banking segments. The corporate banking segment would have decreased from just around 571 million in profit before taxes to 474 million, which was roughly a 17% decline, with the retail banking segment following suit from 386 million to 333 million, or a roughly 14% decline. So no segment was really spared in terms of performance of profit before tax by segment for First. However, like most of the other banking groups, we would want to believe that the worst is now behind us with respect to COVID. So at a price of $43.17, First is trading at a price-to-earnings ratio of 18 times, which is just below the banking sector of 20.9 times, and offers investors a dividend yield of around 3.2%, which is above the sector average of 2.8%. So on the basis of relatively fair to moderately attractive valuations, that potential normalization of performance, or the prospect of normalization of performance, but again with lingering economic uncertainty because of the fact that the recovery timing is uncertain, Bourse is going to maintain a neutral rating on First. Now, what was it like to be an investor in banking stocks, or have a banking stock portfolio or sub-portfolio in 2020? Well, if we had an equal weighted portfolio of every single banking stock on the exchange, including First, FCI, NCBFG, Republic, and Scotia, your portfolio's value would have declined just around 8.9%. So that $10,000 illustrative portfolio would have declined to just around $9,100, or just over $9,100 for the year 2020. Now that's relatively good in the context of lower earnings. And when we take a look at overall that same portfolio in terms of its earnings generation, earnings per share for that same portfolio of stocks would have declined just around 73%, with the major change coming from First Caribbean International Bank, or FCI, which would have fallen from an earnings generating capability of $183 to a loss of $171. Again, much of that attributable to several non-cash charges, including credit impairment losses, as well as the impairment of goodwill in the case of FCI. And from a dividend perspective, or a cash flow perspective, we would have seen a 28.4% decline overall for that exact same portfolio, where dividends would have fallen from just under $1,000 for that particular portfolio to just around, from $665 to just around $400 for that exact portfolio. So overall, from a cash flow perspective, there would have been some pain felt. From an earnings perspective, again, there would have been some pain felt, but in the context of a quite challenging 2020, from a price perspective, an 8.9% decline in your portfolio would not have been as significantly painful as the fall in cash flow generation or dividends. So what are banking and stock investors supposed to do in the coming year ahead? Well, if your view, it all depends on your view. If your view is that the worst is behind us, well, we can expect you may want to expect some improvement or recovery in the performance of these banking stocks. And if not, well, play it a little safe, look at safer investments such as repurchase agreements, income mutual funds, government bonds, for example, and other safe investments or relatively safer investments if you don't want to take that market exposure to the banking sector at this point in time. Well, that's it for this week's edition. For more information, you can give us a call at 2BORS or 226-8773. Email us at invest@boursefinancial.com or check out our website at boursinvestment.com, where all of our research is absolutely free. And of course, you can catch us in today's business section of the Bigger, Better Trinidad Guardian. And on behalf of the entire team at Bourse, we take this opportunity to wish you and yours a very blessed, relaxing, enjoyable, and safe Christmas period. And we'll see you next week on the Bourse Report.